When it comes to investments, we're quite uncertain as to where we should invest: debt or equity, and how much? Gold or real estate? Again, how much? What should be our portfolio? What is a perfect portfolio? We'll discuss all these things in today's Investors Hangout, and you will be able to find what is the right asset mix, or what is popularly known as asset allocation decision. This program is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. My name is Rajesh Lake, and with me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
So, is there something called a perfect portfolio?
Yes, one should actually strive for perfection, but there isn't a thumb rule. There isn't a formula. There isn't a something that you can arrive at with precision that this much should be equity, this much should be debt. But it's important to have those principles in your mind. One is that what is the different kind of asset classes.
Right.
A lot of people think that equity people understand, debt people understand, but people don't understand the underlying how it actually functions. Uh, a lot of people think that commodities are also an asset class, or gold is an asset class, or real estate, and they are an asset class because they are a repository of value. But from an investment point of view, from an investment angle, they are not. I think
Okay.
For individual holder, you are the owner of that business. Whenever you are lending the money, you are a debt. You are investing in debt, whether it be a bank deposit, whether it be a company deposit, whether it be a government bond, or whether it be a bond fund. So this is something which you have to understand, that you become a owner or you become a lender. This is the fundamental thing which you need to understand. And when it comes to becoming an owner, it comes with a certain set of risk, and there are mechanism of reducing that risk. You diversify, you do your SIP, you average it, those kind of things, and make sure that you're investing your long-term money in equity, because equity will not produce or will always surprise you in the short run, because there is no basis to it. Fixed income, predictable. You will not get superlative return. You will not become the benefits of ownership. You will not get huge rewards, but you will definitely, not definitely, but depending on the kind of lending you are doing, if you are giving your money to somebody who is not, who is not trustable, then your money will be, of course, you will be expecting that you will be getting a return. You will be expecting that you are giving it to untrustable person, then you will be getting a higher return. That is called credit rating.
Okay.
If somebody is highly rated in terms of his ability to repay the interest and the principal on time, then it yield lower return. So how much risk are you taking? And so you are lending money and you will get a fixed return. That is why debt is also called as fixed income. Then comes gold and real estate, which is a popular asset class, but you should have a little bit of gold. And gold, I think, in India, the way it is held, should be looked upon as a consumption.
Okay.
There are reasons why you should not look at it as an investment, because of course it is the cost of buying, the gold, the form in which we buy has 10 to 15%, even 20% making charges.
Okay.
Your ability to realize the value of it when you need the money may not be as simple as liquidating your deposit, or redeeming your mutual fund. Then comes real estate. Most of us have thought in terms of, come across all those stories that somebody bought a house and now how valuable it is. Mind you, this is of course real estate. You should look at it as a house. One should have a house, but as an investment, I'm not so sure, because whenever we talk of those lofty returns, we talk of 15 years, 20 years, 25 years. You bought a piece of land and it has become valuable, and what we miss out on is the 20 years time period, 15 years time period in which it has become valuable. If you would have held even Sensex, an unmanaged index, it will be that much. Think of Sensex as recent as 2003. It was at 2,800, and today it has crossed 30,000. So look at this this appreciation. But we don't look at market in these time frame. Whenever you look at market in these time frame, add to it the convenience, Add to it that it comes with no maintenance. You don't have to worry about it. You don't have to worry about paying the property tax. You don't have to worry about keeping it, the upkeeping of it, looking for a tenant, and then realizing it. If you want to sell, can you sell it at will? And then all the returns in equity or long-term equity investment comes to you in the form of a tax-free return. So going by the convenience, so I think investors should do themselves a favor. If they are looking at investment, they should only consider equity and debt. You should have a little bit of gold, enjoy it. Have a house, live in it. If you are able to save on rent and live in that house, good enough. You have also an asset class on which you can bank on. Nothing beyond that. Don't look at real estate and gold as an investment.
So it's quite a myth, according to you, that when investing into a property and all will be like you'll benefit the most out of it. That's a general myth people have.
That is, and that myth actually, and it is not untrue. The real thing is that the behavior of investors when they buy a house or buy a property, you are thinking long term. You can't get out of it, and you end up benefiting from that.
Right.
But you don't think like that when it comes to, if you are disciplined. So I would say that, and today I think it is risky, because the kind of risk which you are assuming while taking a position in real estate as an investment is that you are taking a bet on the builder. Your inability to diversify, it's a big ticket purchase. When you buy a mutual fund, when you invest in a mutual fund or you buy a stock, you diversify. Right. But when you buy a flat or a house or a land, then it's the quantum of money that is at stake is very significant. So if you go right, it's fine. I think it is not a myth, but it is not appropriate for most individual investors trying to do accumulate their savings with their 5,000, 20,000, 50,000, or their lifetime savings accumulating to few lakhs and maybe even few crores. But that is not an appropriate vehicle through which you can diversify, have all the controls, liquidity, tax efficiency. So those things you don't get. So it is good to keep away from that.
So what you're saying is that in the asset allocation, we should have debt and equity, a bit of gold.
Have it in the locker, enjoy it.
Wear it.
It's actually a security. It's an investment of last resort. If I just think of some situation, physical gold, not the government. Of course, there are different forms in which you can have gold.
Correct.
You can have a gold fund, then you can have a gold ETF, then you can have a sovereign gold bonds, and then there were and then you can have physical gold, and then you can have jewelry. Jewelry turns out to be the most inefficient way of holding it. Physical gold in the form of a coin or a bar or something works, but liquidity, I'm really worried. Of course, purity may not be as questionable as you're getting it from. Sovereign gold bond turns out to be the best, because you are able to write, but you don't enjoy it. You don't own gold. The joy of owning gold, which is the prime motivation for people in India being a huge gold consumer.
So apart from this, in the asset allocation, are there any other asset that we should be taking
investors should look at fixed income and equity only. And how to go about allocating is critical, because the basic rule to follow is your convenience and your expertise.
Correct.
So long-term money, and long-term we defined a couple of weeks back that any money which you are unlikely to need for 5 years and more should be considered long-term. Keep that money in equity, and remaining money, all the money which you are likely to need in foreseeable future, which is within next 5 years, I'm just putting a number, a time period to it. Keep that money in fixed income, because you can't bank on the market for the short run. Now, how to mix it up? Because everybody needs fixed income, even if he's a long-term investor. How much? Because that depends. Because we talked about why invest in a balanced fund which is 30% fixed income, because most investors are not comfortable. All said and done, when you see the big swings, and particularly the downswings of the market, it's scary. So it's important that every long-term investment in portfolio should also have a fixed income allocation, to the extent that it makes you comfortable. The simplest way of doing it is having a balanced fund for your long-term investment. If you are investing and you're a very conservative investor, you don't want to take chances, consider those MIPs, which are which is a converse of the balanced fund. It is 30%, 20 to 30% equity remaining in fixed income. It will not get you the tax efficiency, but it will never give you those big declines.
Okay.
You will be able to generate more return than fixed income. Your money will not be, and if you're thinking in terms of little over 5 years, you are likely to generate superior return, even tax efficient, and particularly the tax efficiency which comes from a mutual fund structure. Because when you invest in a mutual fund, all your returns becomes tax free.
Right.
When you invest in a deposit, all the income is taxable in that year.
So
all the interest income.
So how does one arrive? Okay, is there a formula? Is there something that one has to keep in mind? How does one arrive at a suitable asset allocation?
There isn't a formula, but
Yeah.
I would like to, I'm quite tempted to give a formula so that, people can, because
Yeah.
this is such a ambiguous thing that not having a formula, if investors get a formula, then they might follow it, and then they will be able to keep on track. But I think more than the formula, it is important, if you choose the appropriate kind of fund, you will have the formula embedded. Because if you're a long-term investor and you are comfortable with the ups and downs of the market, you are willing to take chances, you will not be upset with big swings in the investment value, then it's fine, building a portfolio of large cap, multi cap and small cap funds, and even having 90% of that money in those, and 10%, a small fixed income allocation of 10%.
Okay.
If you are a conservative investor, investing for the first time and accumulating, doing your SIPs, always start with a balanced fund, because here the formula is embedded in the product. The balanced fund will make sure that your money is always no more than 70% into equity, remaining in fixed income. If you are an extremely conservative investor but getting disappointed with the low return of fixed income, wanting to enhance your return, go for that MIP, because that will make sure that you are not exceeding 20-25% in equity, remaining in fixed income. So you will not. So that formula is getting embedded in that. If you try and implement these formulas yourself, if you decide to have 80% into equity, 20% into fixed income, then you will have to be more proactive. When you're 80%, because equities, when they go up, that 80% will become 90%. Then you will have to redeem a part of your equity, put it in fixed income,
Okay.
rebalance it yourself.
So always
might be a-
maintain 80-20 ratio.
Yeah, that 80-20 is for the long-term investor who is still comfortable, because many investors, when they see the market rising, they think that they can be 100%. It's not a wise thing. So build your asset allocation based on your tolerance, how much experience, and I think it's also a function of two things, which is intangible, why we can't have a formula. If an investor has been in the market for 10-12 years, he has seen the ups and downs and has benefited from that, he will have a far greater belief in the decline and this rebalancing approach. The other is, how important is that money? Even if you're a long-term investor, but what is the scale of money? If this is the only money that you have, assuming that I am investing for 10 years or 20 years, and I'm investing 2,500 rupees with great difficulty, which is about 30,000 rupees a year, that money becomes 5 lakh rupees. When that 5 lakh rupee, after 4 years of accumulation, or 3 years of accumulation, it actually becomes, goes down in value by 20% or 30%, the sheer importance of that money in my life framework is so critical that I will be acting in a haste.
Okay.
So these two things actually differ from investor to investor. How important is that money, and how experienced are you in the market? Once you have, so depending on that, err on the side of caution. If that important money is very important, you don't need to move beyond the balanced fund.
Okay.
It will help you stay on course. If you are reasonably experienced, then maybe. But the combination of these two things actually makes investing, even through mutual funds, reasonably sophisticated, because you have to experience importance of that money. These two things generally don't get factored in our planning.
Okay. And how much does the time factor, time horizon play in this formula?
Time plays a crucial thing. The starting point is that you should be doing this long-term allocation for your investments, because anything less than 5 years, it should
And
get
we
into fixed
discussed
income.
how
Yeah.
long
How
should
long
one
should
be
long-term.
invested. Yeah.
Then as you get closer to your goal, start moving that money. Exactly the way you accumulate gradually, you should, redeem and take your money out gradually. And that is something. So as you get closer to your goal, and once it comes in a vicinity of 3 to 5 years, start pulling that money out gradually.
Okay.
And that will change your asset allocation.
So,
And changing that asset allocation means redeeming your money and start putting it in fixed income. So it's working, but working and finding its place in a manner, in a kind of fund, in a kind of investment which is predictable.
so would I be right in saying that one's ideal asset allocation must keep changing with time,
Yeah, absolutely.
with the horizon of my goal?
Absolutely. And but there are, yes, as you get closer to your goal, and assuming that you have accumulated all the money, and you have reached and you have accumulated the amount for which you are saving, or you are you're doing your gradual investment, then as you get closer to that, it should be 100% into fixed income. And if it is 5 years away, then it should be that 80-20, 70-30, or 30-20, whatever you have decided to be.
Okay. And are there any mutual funds that make the job of asset allocation easy?
Yeah, what I was referring to is MIP, the balance fund, or the equity income fund. They do it automatically. You don't have to bother about rebalancing yourself.
Okay. So I hope viewers, you've been able to figure out as to what is the right fund mix that you should have. And as Dhiren said, it should be a mix of equity, debt, bit of gold, and of course, you should have a house of your own.
Yeah.
So these four factors are important. Time horizon is extremely important. You have to ensure that you are invested for at least, if I go back to the programs that we did, at least for 5 years you need to be invested.
That's the definition of long term, and that is something which should be generally more equity oriented. A majority part of your investment should be in equity.
Okay. Now we move on to the questions that you've sent us, and the first one is from Ashok. There was a news of merging same type of funds offered by an AMC. When and what will be its future consequences?
Yes, SEBI has brought a new law, new guideline, whereby mutual funds having similar kind of fund will have to merge it. It will not have a very significant consequence for investors because the merger will take effect only for those funds which are similar.
Okay.
They will have a superior scale. Some of the funds will have a disadvantage that they will become too big. They will become very big. But that apart, there is no tax consequence because last year's budget, it provided for, it made a provision that if your fund is getting merged, then there will be no tax implication. It will be considered as your old investment.
Okay.
Earlier, the situation was that a fund merger amounted to redemption of your old investment and new investment being made into the merging fund. So if you are in a fund which was actually merging into another one, then there was a tax consequence because if you are sitting on long-term gains, then it would suddenly got redeemed without you asking for it, and then it got invested, and then from there on, the taxi started that 365 days till it actually becomes a long-term gain. Now that problem is not there. Every investor will also get a zero load exit option. So, and the fund merger is fairly mechanical in terms that you will get units of the new fund or the other fund, depending on it's a simple division. Assuming that a fund's NAV is 50 rupees and the fund in which it is going to merge is 100 rupees, then you will get one unit for all the two that you're holding. So it will be a simple division of the two values, and you'll get the allotment of
the investors are not going to be
no, it will not have a significant impact because the merger is going to be effective only for similar funds.
Okay. We move on to the next question, which is sent by Anand. He writes, I want to invest some money for regular income in debt funds. I chose 8 debt funds based on ratings and returns and invested in them. 45 days on, 4 of them have given negative returns. 2 are dynamic bond funds, 1 gilt fund, and 1 income fund. What should I do now?
If you are actually, money for periodic income, and regular income without significant downside, because dynamic bond fund and gilt fund, whenever the outlook changes, they might get a hit.
Okay.
Not that it's unusual. If interest rates go up, mutual funds, the debt funds actually go down in value, because the older, that's the mechanism. Old bonds held by a fund which will be yielding lower return gets priced down. So from that standpoint, but if 45 days, if you want regular income, get conservative with maybe a short-term debt fund that will insulate you from any of these interim declines, because
Okay.
the particularly the gilt fund and the dynamic bond fund, over a long period of time they will give superior return, but their return will have the ups and downs. So the income fund, the dynamic bond fund, gilt funds are not suited for consistent return. If you are looking for consistent return month after month, day after day, you should consider a liquid fund or an ultra short-term bond fund and short-term bond fund, nothing else.
So when
Choosing
should
the
one
appropriate.
exit from them?
But depends, looking at return on a 45-day basis from this debt fund, he could be in for a surprise, because if interest rates go up, it could be, these funds can actually take a hit. But debt funds do take a hit, but the magnitude of hit, the negative return will be of a very insignificant kind.
Okay.
1%, 2%. It doesn't happen like equity that your investment value is down 15%. So look at this time frame. If you want regular income, move to short-term debt fund. If this is a long-term fixed income investment because you are a risk-averse investor, maybe you should consider staying in some of the dynamic bond fund. Definitely not in the gilt fund, because gilt funds, they reflect the change in the outlook of interest rates immediately. They turn out to be far more volatile, simply because they're more liquid.
Correct. Anand, I hope you've taken note of that. And our next question is from Binay. And he writes, I have accumulated enough money through mutual funds to purchase the kind of house I was looking for. Should I buy it therein entirely by using the corpus accumulated in mutual fund, or just pay the down payment from the accumulated corpus and take home loan for the rest?
Yes, normally.
Interesting question.
Yeah, and a very important question,
Yeah.
and I think it will have very major consequence in terms of our conservatism says that if you have the money, go ahead and buy it. But this, yeah, and normally at Value Research we always keep discouraging investors never to borrow, or not to borrow as much to the best of their ability. But this is one borrowing which is worthwhile, because this is a long-term investment.
Okay.
This is a long-term loan. You will be paying the EMI, and my sense is that so make your down payment. The money which will be lying in your mutual funds will generate superior return. Your EMI, the cost of your EMI, the money that you will borrow for buying the house, maybe be liberal with your down payment. Don't put the marginal one of 10% or 20%, maybe put 35%.
Okay.
So you are not borrowing as much, and you're on the conservative side.
Okay.
Take the long-term loan, and 10-year loan, 15-year loan, you will be incurring a cost of 10.5%, maybe lower in future. And the return on these investments are bound to be very high. And if you can actually support that EMI without much of a problem, then this is the long-term borrowing which we support.
Okay.
Which we suggest, which we encourage.
So 35 to 40% in
Yeah,
there.
put a
Take
good
it
margin
from
and
your mutual funds and get into loan.
Put a liberal down payment and borrow the long-term money.
Okay. I'm 65-year-old man with no commitment. I can take risks. Should I still follow the 100 age rule? Asks Arul Prakash.
No, this is a problem of the thumb rules. 100 minus age rule doesn't work. It is trying to simplify things. Of course, it is too big a generalization. I would say that circumstances have changed. It depends on the person. If you are even if you are 70-year-old and your income needs are very limited and they are easily met by some income source, and all your money is going to be targeted at leaving a larger state, then I think even at 75 you can be all equity, maybe 10% fixed income.
Why not?
Why not? Because that rule was is oversimplification. I think this asset allocation should be a function of your specific needs, your aspirations, and unless you need some income, because that
And he
asset
writes he
allocation
has no
formula,
commitment.
no commitment, and if
Hmm.
your income needs, you are not dependent on your investments for income, then it could well be long term equity investments.
Another person, Anant, writes that I'm 54 years of age. I'm planning to retire in the next 5 years. Currently, I'm investing in diversified and mid-cap equity funds through SIP. Should I continue my SIPs in equity funds or stop them and start investing in balanced funds through SIP?
I would say that it depends on the kind of fund you are investing, and most importantly, it depends on the income requirement that you have post retirement. Right now, you are still in the accumulation phase, and you do not have an income requirement from your investments. So, if you are comfortable with these diversified equity fund and mid cap fund, carry on for next 5 years. 5 years is a long enough period. Once you retire, then do your calculation how much money you need from your investments, all your accumulation, even the superannuation benefits and other money that you'll have on retirement, and then it will require a little more careful planning, that how much money you plan to derive. Maybe that will be the time when you should get a little conservative, invest in a balanced fund. You will be assured that it will not be very volatile as a mid cap fund or a diversified equity fund. Also, it will be reasonably tax efficient. And in post retirement, our mindset changes, because we tend to get a little conservative, though your needs might be very different, because the stoppage of income, which we have been used to for a lifetime of our working life, makes us conservative. So you should get a little conservative. Consider moving all your money into one or two balanced fund. It will be tax efficient. Not now. If you are with good funds, and carry on with your
And
SIP.
when should he start to withdraw, have a systematic withdrawal plan? At the
Depends on
60 or after that?
it entirely depends on his
His need.
requirement, because if
Okay.
he is a government employee, if
Hmm.
he's going to get a pension and he needs only supplementary income from his investment, then it could be less periodic. Moving all his money into a balanced fund and then doing a 2% 3% withdrawal from that, and then revising that withdrawal rate depending on the investment value every year, is the
Okay.
most prudent way of going about it.
Okay. Next question is from Abhijit, and he writes, why have balanced funds in general not performed well in recent times? My manual, 70-30 allocation to equity and debt funds, have given better returns than the balanced funds.
Depends. No, my sense is that most balanced funds have been able to deliver uh, reasonable return, good return. And when I look at the convenience, when I look at the tax efficiency, because if anybody would have looking at last 5 year or last 3 years, assuming somebody was doing a quarterly rebalancing with a 70% equity, 30% debt, uh, there are a lot of variables involved in this. Which equity fund one was investing in, which fixed income fund one was investing in.
Hmm.
But generally speaking, I think the return will not be very different. Balanced funds, the kind of convenience, tax efficiency, they deliver. Because look at it, all the money that you would have realized from your fixed income allocation will be taxable, because they are short-term income. All your return from equity, if you are doing the rebalancing more often, that will also be taxable. If you have held it for over 1 year, then only it becomes tax free.
Correct.
So going by the efficiency, rebalancing convenience, and not so steep cost, but it entirely depends, depending on the kind of funds. If you can do it yourself, by all means do it, but look at post tax total return that you have realized. I think for most common investors, balanced fund turns out to be a great way to be in control and derive optimum return.
Last question, and you have touched upon it. Murli says, which debt fund should debt fund be an essential part of investors' portfolio? If so, what ratios in comparison with equity?
Uh, which ratio in comparison to equity is a very complicated thing. That is what we have discussed at
Discussed,
great
yeah.
length. It depends on you. But debt fund, which one to invest in? Uh, that is a fairly straightforward question. Your long-term fixed income investment, consider those balanced fund, because you are getting a component for your long-term investment. Try and choose a hybrid option because they are convenient. They provide you the flexibility. At the same time, if for a defined time period, if you are investing for a few days, the money which you might need at any time, put that money in a liquid fund or a ultra short term bond fund. If your medium term money, the money which you are likely to derive your income from, or doing a SWP, or doing a systematic transfer plan, or taking the money out for consumption at a regular on a regular basis, like your bank account, but trying to optimize the return, consider short term bond fund, nothing else.
Okay.
And the other kind of fixed income fund are meant only for somebody has a view on the market, or can withstand the big nominal ups and downs. They are not very risky. They go up and down. We came across that question that he has generated. He has seen negative return in bond fund, but the magnitude of those negative return will be very nominal. It will be 1%, 0.5%, 2%, and it can happen sometime. You do never see a massive capital erosion. So consider ultra short term bond fund or liquid fund for immediate needs, short term bond fund to be assured that the money will not go down in value if you are holding it for at least 3-4 months.
We're running out of time now, and it's time for us to say goodbye to you. But before that, a big thank you, Dhiren, for answering all the queries. And I'm certain that you have figured out what is your right asset mix. Till we meet again, continue to invest. Goodbye for now.